The global financial system today runs largely on US dollars.
Banks, investors, and corporations around the world depend on dollar funding.
Yet the supply of dollars ultimately begins inside the United States.
In normal conditions, dollars flow smoothly through global markets.
But during financial stress, the world can suddenly run short.
Banks across Europe and Asia rely heavily on dollar liquidity.
Many of those dollars actually circulate outside the United States.
This offshore network became known as the euro-dollar market.
It allows banks worldwide to lend and borrow in dollars.
Over decades, this offshore dollar system expanded globally. Many global commodities are priced and traded in dollars.
Energy and metals markets frequently rely on US dollars.
This creates constant global demand for dollar liquidity. Corporations around the world issue bonds denominated in dollars.
Those debts must eventually be repaid using US dollars.
When markets panic, institutions rush to secure dollar liquidity.
Demand for dollars rises sharply during financial uncertainty.
Funding costs begin climbing across global financial markets.
Banks suddenly compete for a limited supply of dollars.
This moment is known as a global dollar shortage. Foreign banks often carry large liabilities denominated in dollars.
Many institutions finance assets using borrowed dollars.
This network connects financial centers across continents.
Dollar liquidity moves through a complex global system.
When the network slows, funding stress spreads quickly.
Financial stress often first appears in short-term funding markets.
Traders watch dollar funding indicators very closely.
Rising funding costs signal tightening dollar liquidity.
Markets begin urgently searching for available dollars.
The shortage spreads rapidly through global banking.
This dynamic became visible during the financial crisis of 2008.
Foreign banks suddenly struggle to secure dollar funding.
The Federal Reserve responded by providing emergency liquidity.
Swap lines opened between major central banks worldwide.
These programs delivered dollars to banks across the world. The Federal Reserve became a global lender of last resort.
The world once again turned toward the US dollar.
Markets stabilized as dollar liquidity returned. But the global system remained deeply dependent on dollars.
The US dollar venue continues to anchor global finance.
Central banks around the world hold large reserves of dollars.
These reserves help stabilize national financial systems.
But reserves alone cannot satisfy sudden global demand.
During crises, demand for dollars can surge worldwide.
Banks and investors rush to secure dollar funding.
Central banks begin coordinating to stabilize dollar funding.
The Federal Reserve opens emergency dollar swap lines.
These swap lines deliver dollars to foreign central banks.
Foreign central banks then provide dollars to local banks.
Gradually, dollar liquidity begins returning to markets.
Despite crises, the US dollar remains the dominant currency.
Investors continue trusting assets issued by the United States. U.S. Treasury bonds attract investors seeking financial safety.
During uncertainty, capital often flows toward dollar assets.
These flows reinforce the central role of the dollar. Wall Street sits at the center of the global dollar system.
Capital moves constantly through dollar markets worldwide.
Banks connect through a vast network of dollar funding.
Capital moves constantly through dollar markets worldwide.
But during panic, this system can become fragile.
When fear spreads, global demand for dollars rises quickly.
Funding pressure begins appearing across international markets.
The world once again searches urgently for dollar liquidity.
Attention quickly turns toward the Federal Reserve.
The Fed holds the key to global dollar liquidity.
Its monetary decisions ripple across global financial markets.
The global system ultimately circles back to the dollar.
And Wall Street remains its financial center. Behind many crises lies the search for dollars.
When dollar liquidity tightens, the system begins to shake.
Central banks coordinate to restore dollar liquidity, initiating global stability measures and coordinated liquidity efforts.
Gradually, stability returns to financial markets.
But the structure of the system remains unchanged.
The dollar continues shaping global finance.
When dollars tighten, the entire world feels the shock.